All right. Thanks for joining us, Troy.
Thanks for having me. Good to be
Yep.
here again.
All right. So we're trying round two here for the audience. I will say we do have a very engaged audience. I probably had 5 or 6 people message me afterwards saying, looking forward to it. Let me know when the recording's ready. So at least we had built up some anticipation.
And I want to just right off the bat extend my apologies. I don't know whether you were generous in suggesting that maybe it was the AWS outage that had sort of immediately preceded our prior proposed timing for the webinar. Maybe it was operator error. Maybe it was a combination, but my apologies to you, to the audience, et cetera. And glad we're able to get this out and get this in front of the audience.
Yeah, excellent. Well, look, this is part two, just kind of a continuation based on what's going on in the world right now. Last time we talked was early September, so it's a different ecosystem than it was even since then, it seems. So you and I talked quite a bit, and I know when we were talking through some different ideas here, some recent examples, I think from both of our sides, were about relationship and communication during the process. So one of the things I know I have some examples, but I think it'd be good for the audience, whether they are a lender, whether there are founders, we have a little bit of both. How much do you see when, because you sit in the middle, kind of like I do, how much do you see the relationship and communication during the process from a, hey, we're kicking tires through closing and managing the deal afterward? How much do you see that playing a role?
Gosh, it's a great question, and maybe it states the obvious, but the that sort of triangle relationship, founder, debt provider, VC, whether that's the board, whether that's management, whomever, but that sort of triangle, the and open communication channel is absolutely critical. It's critical in really everything that they do. In that, I'm drawing a circle, even though I described it as a triangle, but in that circle, in that triangle, when a founder is out, or a series of founders are out trying to raise capital, whether debt or equity, the channel of communication has to be always on, always open. Certainly when my area of the world, as you know, James, is much more on the debt side of the house, but obviously the debt doesn't happen without the equity. So we see it both, and we see the communication, including, by the way, with debt providers and equity, because the debt providers are diligencing in part the deal based upon the level of support of the board, the venture capital firms sitting around the table, et cetera, et cetera. But once we get into the deal, for sure, communication remains king or queen.
No.
The simplest example, as you know, James, is like the monthly compliance certificate, the monthly
Yeah.
reporting that has to get done. And you and some of your audience may recall, I'm a recovering bankruptcy or insolvency lawyer, and I raise that in part because oftentimes we'll have the conversation with a lender about the idea that, look, if the compliance certificate is late 1 month, maybe it's no big deal, a couple of days. When the compliance certificate or the reporting in general continues to be late, the lender needs to start asking questions. Hey, what's going on? What's driving that behavior? And look, there are oftentimes credible, defensible reasons why they're late. Could be a variety of things. But if the partner, if the lender, if the board doesn't know what those reasons are because it hasn't been communicated, you begin from a position, the founder, the management team begins from a position of being one down because the recipient feels like they haven't been communicated with, and then there's a fear of dishonesty or worse. And that's
Yeah.
often not the case, right? It's just a matter of, look, we have to be willing to deliver that bad news, or even if it is just a matter of, hey, my compliance certificate is going to be 3 months late this time because I had a glitch in the system. AWS went down or whatever.
Yeah.
It's not always a bad reason. It's just a logical reason. And if you're not communicating, though, you risk losing trust.
Yeah, it's we do a lot of work with bankers when they want to keep a portfolio company, but like I think they need a little bit of help. So we'll go in there, and the most common thing is, look, we know we're okay money wise, but we're tired of getting the financials late in a bad format from 3 different people. They come piecemeal, so yeah, it's crazy how much that happens. And back to the communication piece. So we're
Yeah.
actually still working on a deal. I probably even mentioned this on our first version because it's always one more thing that happens. But there was some miscommunication between accounting and legal and the borrower and the lender. The borrower and the lender were on the same page, but something happened where it didn't make it full circle. And I actually got a call from the company today. He just called the lender up and said, "Look, here's what you and I talked about. Here's what we got." It was a maybe 5 minute conversation, he said. And they ended it, they're like, okay, what is actually needed here? And rather than going back and forth, spending thousands of dollars on accounting and legal fees, everyone was just on the same page leaving the call. So it is crazy how much a quick phone call can make a big difference. Good news or bad news, if someone knows bad news is coming, you can at least prepare for it.
Yeah, I mean, look, that's exactly right. And here's a spot too. I was just having this conversation with somebody about, leveraging technology to everybody's benefit. And
Mhm.
what does that look like in this context? It's as simple as recording a Zoom conversation with permission, letting everybody
Yeah.
know, of course, not for the sake of, well, you said this or you said that. No, it's about, hey, I want to be sure that I remember everything that was said, and getting a
Yeah.
transcript off of the Zoom recording. Or in the very unlikely event that someone says, hey, you never told me you were going to be 3 days late. And you're sitting there thinking, wait, I thought I told you on that Zoom meeting. Well, if you didn't leverage technology, that simple, like push the recording button, you end up having
Yeah.
to sort of defend yourself when you might not actually need to defend yourself. The other spot here where technology can be the management team's friend is in the automation sector of the financials, the reporting, the
Yeah.
delivery of the reporting, et cetera, et cetera. Some of the larger private credit providers are now requiring that their portfolio companies leverage some of these various software platforms for purposes of
Yeah.
delivering consistent, to your point, consistent look and feel of financials, and on a timely basis. Now, obviously it's garbage in, garbage out. So if the company isn't inputting the data or inputting it correctly or inputting it timely, the best software can't generate a good report. But if you make the assumption that all of the systems are working as they are supposed to, and a company is effectively leveraging technology, we sort of remove one of those barriers that comes into place as it relates to communication. And so you create the situation where there's almost zero excuse for delivering compliance certificates, to use the example, not on a timely basis.
Yeah.
Yeah.
And honestly, sometimes we'll get referrals from lenders and, I'll ask them, why can't you do anything here? And sometimes it's a reasonable thing. Like our fund life cycle won't allow us to extend the IO anymore. We're too expensive for them. They've outgrown how much we can give them. And every once in a while, it is, you know what, they're fine. I know we're not going to lose money, but I'll be honest, they're always late. There's always an issue. There's always a little bit of an annoyance. I mean, that does make a difference because I think one of the big differences that companies tend to find they need to get comfortable with, because it's always something they're terrified about, but then very few actually seem to adhere to it, is the reporting, the borrowing base, the covenant. But then half of them don't pay attention to actually following the rules as it is, which I think is one of the big differences that companies have to get used to the first time they take on credit compared to equity. Because equity, you can argue VC versus private equity versus growth equity, whatever, and their various behaviors. A lot of times it is write you a check, but VCs are writing dozens of checks to similar companies. They can't be hands on with every single one. So, they look at surface level, not, all your detailed reporting necessarily. So I think that's something that companies have to get used to as far as what the difference is. But what we've seen here, and I know one of the things that we were going to talk about is when using debt makes sense versus not. Definitely makes sense when you have the infrastructure. Obviously, if you don't have the infrastructure, regardless, you should get it. But we've seen debt make sense for companies when they have that in place and they can actually see an actual return for every dollar that they borrow. Versus equity can be more theoretical. Like you're not going to account for every dollar of a return on a $25 million round. But, if you're borrowing $4 million at 12.5% plus warrants, say it costs you 15, 16%, you need to actually calculate out, are we going to get plus 16% on that?
That's exactly right. And I think most debt, if not all debt providers, will tell you in this sort of sector in which you and I principally operate. Debt's best use is to extend the runway between the
Yeah.
rounds, right? It's not to it's not to fill holes on an emergency basis. That's a debt provider who hears that story doesn't hear that story well and get a warm and fuzzy feeling about writing a check in that scenario, right?
Yeah.
They to your point, James, they say, okay, well, you've raised an A and a B, you've raised them from these increasingly recognizable, reputable, credible venture capital firms and or providers. And what is the next inflection point? And is debt the appropriate capital tool to use to get from round B in my example to C?
Yep.
And very often it is. And to your point too, the founder needs to be prepared with the support of the venture capital team sitting around the table, of course, to be able to demonstrate both the use case and the anticipated outcome against why are we using the debt, what do we need to use the debt for, what does it actually look like, what does it mean to say we're extending the runway between rounds, what does that mean, what's it look like, is this for customer attraction, is this for signing new contracts, what are we planning to use the debt for? So there are absolutely, good and positive and fair and right and credible stories for using debt. And then there are some that are not really the best story to be telling your debt provider in terms of what you need to use the debt for.
Yeah, I think I don't always agree with the reason that lenders will say it, but it does make sense probably at least half the time is, we can't take equity risk for debt returns. The whole point is debt's supposed to be cheaper, de-risk, not completely risk-free. That's something I like to make clear to companies is a company without tangible assets, without cash flow, limited on cash balance at the time of funding, that's why there is risk associated, but you have proven customer traction, you have use of funds, you have a good management team. You're not betting on a vision, you're betting on execution or continued
Right,
execution.
right.
So, yeah, I mean, we see that quite a bit where some companies will say, "Oh, we see it a lot in the clean tech space, for example. I'd love to borrow 400 million because as soon as I do, I'm generating $1 billion a year."
Yeah.
That's not where debt comes in. Debt
Yeah,
comes in.
I've heard it said, hope is not a repayment strategy, right? So that's your example. We hope that here's where we're going to be.
Yeah,
There isn't a provider, at least that I'm aware of, a credible provider that goes, hope is a strategy. No,
yeah.
doesn't work that way. Yeah,
Any lender who agrees with you on that, I would double check the fine print in those terms.
right. That's exactly right.
Uh,
The other is, and consistent with kind of these themes, right? Debt needs to be or we talk about, sort of this notion of like a bridge. Is it a bridge to the next round? That's the extending the runway, or is it a bridge to nowhere, right? Is it
mm,
actually a plank? And again, not a good time to attempt to deploy debt or even attract debt when we don't have what sits at the end of that bridge and it becomes a plank.
yep.
Any provider that looks and says, well, I don't see what I'm bridging to isn't going to write that check. And I use the term bridge broadly to mean the runway between rounds.
Yeah, and I will say the way we see a lot of companies, because admittedly, we classified everything we've always done for the most part as venture debt. Most of our clients have been technology companies over the years, generally cash burning, most of them investor backed in some way. But we've only done, I think, maybe one deal where it was your traditional venture debt, recently funded, needed capital. And that was just luck of the time. And I'll admit it, they did not need us. But a lot of times what we see is that the bridge in the funding is it can be a bridge to profitability. A lot of
Mhm.
our clients right now, they have okay cash balances, but they want to continue growing at a steady, 30% a year. They don't want to worry about running out of cash. They might have a 3 to 6 month gap, but with where they're at, they can borrow, effectively 18 to 24 months worth of expenses. Lenders are comfortable with that. The second one we see a lot is bridge to M&A. So we have a lot of companies, borrow a 4 year, 3 or 4 year term, ideally target an exit within the next couple of years. The third one, actually, we're seeing a lot right now is borrowing to get to cheaper bank debt. And they're not even banking on what rates are now. It's rates a couple of years from now, where a lot of banks are calling us and saying, "Hey, I can't help this company don't want them going across the street to my competitor who will knock, maybe 50 basis points off the cost and I lose the deposits. So we're actually seeing companies say, look, I'll borrow this for 1, maybe 2 years, and I'll go back to even a lower cost of capital bank at that point. So to your point, there is always a bridge to something. Bridge can kind of have a negative connotation. So I always like to clarify with people, it's not, hey, a 6-month term loan or something that's going to kill you cash flow wise. But there needs to be something at the other end. Otherwise, people don't want to put money in a black hole.
Right. Otherwise, it's called a plank.
Yeah.
Yeah. It's interesting. You made the comment about, venture debt and really only one of, so many that are true sort of traditional venture debt and venture debt, as ubiquitous as that term is, as widely used as that term is, it is sort of a misnomer these days. And we've seen the advent of this phrase, at least private credit, which generally speaking means non-bank, provided credit. It's become this, sexy word as if it's actually something different than what's been going on for the last 10, 15, 20 years. There sort of have always been non-bank credit providers, but it sounds more interesting. But really, I mean, you're right. The segment of lenders that are really providing what we used to call, or what is traditionally, and I think as you're thinking about it too, venture debt is actually a pretty small segment. It's a pretty small group. Of course, you've got, SVB, which will still write checks to, very early stage companies. Different model, as I understand it, than the SVB of old, for probably what are obvious reasons. But most of the providers that even sometimes call themselves in the right circles venture debt providers really think of themselves more as growth debt, right? And
I remember you and I talked about that before.
Right. They even have it in their name. And the thinking is, to this same point, look, this isn't we're not filling holes. This isn't emergency capital. This is extending runway between rounds. And so therefore looks much more like we are supporting the growth of the company, right? Venture debt, historically, as originally sort of contemplated, et cetera, was really, debt provided to early and growth, but early stage venture-backed companies. Venture debt was really, now you've raised your first institutional venture round. Now you are ready to raise venture debt, typically provided by a bank. That segment is not quite gone away. There's still a need for it, but you're exactly right, James. It's a sort of a much smaller segment of the market, certainly in private credit, than is the growth debt piece.
Yeah, it is interesting because it's always easier just to say work in the venture lending space, because private credit, everyone is like, oh, just middle market, whatever it might be, any type of non-bank lending. But yeah, we'll talk to people sometimes, and especially prospective clients, who will introduce ourselves like, oh, is this venture debt? We haven't raised equity. It's like, well, kind of. So we a couple of years ago, there were a lot of things we realized it was just getting tiring, and it was difficult to explain in real time every single conversation. So we tried to put a lot of content educating people on venture debt versus, basically venture debt of old versus now. And it's been good because the market's expanded. A lot of private credit providers, whether they call themselves growth lending, venture debt providers, private credit, if you're lending to a cash burning software business that has raised equity before, maybe they didn't raise a recent round, but I don't see much of a difference as far as the risk profile in a lot of ways.
Yeah, agreed. Agreed. I think that's exactly right. I want to go back, if we can, because one of the things, James, you and I talked about as we were preparing for this, and we were talking about the sort of working together in that kind of, whether it's a triangle or a circle of venture capital, debt, and founder, is not just the communication piece, but sort of playing well in the sandbox. And again, in the bucket of stating the obvious, one of the things you and I had talked about, that I always talk about with my team, is that we on the lawyering side anyway, can sometimes, what I view as, make the mistake of calling the parties at the table adverse parties, or opposing
Opposing
parties, or opposing interests. And the truth of the matter is, and we really try to approach the deals that we do in this way, and that is, turns out our interests are actually aligned. We may use these sort of psychologically charged terms like adverse and opposing and blah, blah, blah. But the truth of the matter is our interests are actually aligned. How? Lender sits there and says, I have a pile of money. I would like to give you, borrower, that pile of money, right? Borrower says, you have a pile of money and I would really like that pile of money. And by the way, if you lawyers could do your thing, we recognize you need to protect each of us, our, the respective sides. But if you could make sure that that pile gets to me as intact as it possibly can, please don't take too much off of the stack. We would really appreciate it. And we really try to take that approach that, sure, when we're representing the lender needs to have certain protections, right? It needs to be sure that it can get repaid, that the repayment provisions are there, that the interest and the deal terms are accurately stated, that their security is in fact perfected, et cetera, that they have an enforceable loan. The borrower has certain protections that they need to be sure are included in the documentation. If they're taking on term debt and it's for some acquisition activity, they need to be sure that they can do the acquisition, et cetera. But really, at the end of the day, the goal is to move the pile of money from one side of the table to the other. That makes their interests aligned.
Yeah.
Why do I say all that in the context of the can't we all just get along? Part of the communication, part of ensuring that at the very front end, at the diligence stage, the term sheet stage, that the lender in this scenario is feeling like the borrower is effectively partnering with them, is delivering the information that they've requested, is sort of building this assurance that I, as the borrower, appreciate that you are my partner in this transaction. So
Yep.
absolutely, you expect to get repaid. You should get repaid. By the way, same thing with the venture capital firms sitting around the table, the board, right? Theirs isn't a repaid, but theirs is attempting as far as possible to assure that there is a return on investment, ROI, right?
Yeah.
So everybody around the table has a shared interest in the success of the business. And so while there are certainly times where people aren't going to agree, where interests are not entirely going to be aligned, for the most part, the interests are actually aligned. And
Hmm.
again, maybe it's against my interest, but the lender, the venture capital firms, the company really need to ensure that the lawyers don't get out over their skis and attempt to take too much control of the process, lest that pile of money shrink unnecessarily as it makes
Yeah.
its way across the table.
Yeah, it's something that, I'm sure you have to remind your clients. I know I have to remind both sides. Like, we're all on the same page. The lender, like you said, the lender wants to put money out. That's how they make money. You need money to keep the lights on sometimes. So, make sure everyone's on the same page. And back to our first point, communication. I don't know about you. How often do you, because I hear a lot like, oh, their lawyer didn't listen. It's like, well, do you know that their lawyer didn't listen? Or is it possible the lender didn't communicate exactly what you talked about on the call? Is it possible you did not communicate to your lawyer what you guys talked about? Oh, yeah, I might have forgot to mention that he and I already talked about this. So it is
Yeah,
important.
and that's right. And look, my wife is a lot smarter than me. She says things to me like, leave room for the possibility that there might be a rational explanation for what at first seems not rational, right? That said, and it's great advice, and it's true, and I try to practice that
Yeah.
personally and professionally, really, really, right? But to your question, to your comment, it's not unusual when in a negotiation where we will say to the lender, we've received a markup, right, of the loan
Yeah.
documents. We'll say to the lender, gosh, the borrower is asking for X and Y and Z, for example, an acquisition bucket on a
Yeah.
$5 million, deal for a Series A company, right?
Yeah.
Really? Do they have acquisition, projected in their financials? Maybe they do, but I'm going to say to the lender before I just say no as the lawyer. It's not my
Oh,
product.
yeah.
No, I have to understand what is the business deal. To your very point, James, what conversation, lender, have you had with the company? Do they in fact have acquisition in their future, in their near term, that we should be
Yeah.
permitting acquisitions in the context of this document? Unfortunately, I will say that it's not unusual that the lender will come back to us and say, hey, we spoke to the company about X, Y, and Z comments that were made. They had no idea that their lawyers made those comments.
Yeah.
It's a really unfortunate experience. Now, look, you know this about us. My team and I, about 85, 90% of the time, we're on the lender side of the transaction. The other 10, 15% of the time, we're representing borrowers, right? In these same transactions, obviously not against our same lender set. And we take a very different approach. And the approach
Mhm.
that we try to take is actually asking questions and then listening to the responses. That
It's
is,
amazing how much
hey,
that works, right?
right? Hey, company, we need to be sure that the loan agreement, the loan documents contemplate what you've got contemplated for your business over the course of the term of this loan. So the loan in some respects needs to be sure that it's a growing, evolving document. It's not going to permit everything you want, but
Mhm.
obviously you'll go back during the course of the relationship. But for example, can you make the reps warranties and covenants that are included in your document? I don't know if you can or can't. I'm going to need
Yeah.
you to look at that. Are the dollar amount buckets in the permitted indebtedness and liens investments, are those the right size for your business and for what you're
Mhm.
contemplating for the course of this loan? Or do we need to increase them? Or maybe there are some you don't care about. The one that I love, my team always gives me grief about this, is the one where a Series A company goes, oh, well, we need to, and it's the lawyer, and the lawyer's trying to do their job. I'm not taking anything away from
Yeah.
them. And again, could be a rational explanation there too, right? They go, hey, this is also a blank VC backed company. Let's ask for the same stuff we got in this other
Yep.
blank backed VC
Similar
company we
lenders,
negotiate,
similar,
right?
yeah,
Yeah.
similar thoughts.
And sometimes that's appropriate, sometimes it's not. But, oh, well, we need room to be able to finance insurance premiums. And I always look at that and I go, really? Are you really financing insurance premiums? Like, now look, if you're a more mature company, right, and you
Yeah.
probably have a much larger debt facility, maybe you are, and maybe that is a good use of money. But in my experience, very rare for a Series A, B, even C company, depending, that they're actually financing insurance premiums. So we can always tell, like, does the company even know this is what's being asked for? Now, again,
Oh
not
yeah.
my province to make that decision. We're just the lawyers. We're going to ask the business people, is this part of the business agreement? And by the way, even if it isn't, the lender may say, you know what, we don't really care. It's a small enough money. We're comfortable with the company. And if they want to finance insurance premiums, just to use that example, we're happy to let them do that. But the point
Yeah.
is, that's not my decision to make, right? As the lawyer, that's a business
Mhm.
level question. I'm going to ask the company, happen to finance insurance premiums? Do you want us to ask for that? Or, what's the approach you want to take? And sometimes too, just to complete the thought, again, consistent with this entire theme of communicating, we're partners, our interests are aligned. We'll say to the borrower before we ever start putting pen to paper, what kind of review do you want us to give this document, right? Now we're on the borrower side. Do we want to just make sure that the term sheet, that the loan document lines up with the term sheet? If the term sheet says it's a $5 million term loan, does it say five or does it say four in the loan document, right?
Yeah.
Let's make sure that the documents line up with the term sheet. Or do you want us to take it a little further and make sure that all of the reasonablys and the materiallys and those kinds of things are built in? A level 3 is all of that, level 1 and 2, that, without describing those as such. Plus, hey, let's try to get greater room. Let's build in these baskets and permitteds and all this kind of stuff. Let's see
Yeah.
if we can get a permitted acquisition bucket. Like, okay, really? Are you
Post
sure
term
you want
sheet
to do that?
negotiation. Yeah.
Right, exactly. And level 4, I always tell borrowers, like, don't bother. That's the equivalent of scorched earth, right? Where
Yeah.
you just have all the negotiating leverage in the world. You really don't need this deal. And so we're going to just tear this document apart. We see people taking that approach.
Yep.
I'm going to tell you, to your founder set, please tell your lawyers don't do that. That's not a valuable exercise, even if you have all the negotiating leverage in the world. Why? Because you're going to cross paths with that lender again or somebody in that syndicate. It's just a bad idea. It's not necessary and it doesn't advance the ball. So again, can't we all just get along? Rodney King, circa
Yeah.
1990. And we can, it turns out we can. The lender wants to give you the money. They really, really do. They just want to be sure they can get repaid.
My business partner's dad always told us, remember, be nice to the people on the way up because you run into the same people on the way down. We've seen some pretty high flying Series A companies, and we end up crossing paths with them a couple years later. It's like, oh, how's it going? And their revenue flatlined, or even worse, they spiked and then plummeted. They VCs backed out because they're like, well, you didn't perform. Your other companies or the other company we have similar to you did, so we're diving into them. And to your point on the communicating with attorneys, I don't know about you, I wasn't a very good student. So whenever it came time to do like a project in class, if I hadn't paid attention or the lawyer equivalent in this case of not being told the assignment, you just kind of go blindly. Same thing. If a lawyer's just handed a document and there's given no indication of what to
Right,
look for, your default is okay. Well, let me make sure I'm protecting my client here to the best of my ability. You don't know if it's 1, 2, or 3 level, and
right, right,
some attorneys do
right.
check with the client, some don't, just say, yep, this is what I would do. And then,
Yeah.
luckily, we've really been educating our clients about check what your lawyer sends first. You may have
Hmm.
communicated with them. Maybe the partner did it that you talked to. Maybe an associate did it and the partner, glazed over it and he said, that's what I would do. Maybe he didn't. So, just double check everything. And, you catch a lot because, like, oh, actually, I forgot to tell you, lawyer, we already talked about this. We don't need this in here. It's very immaterial.
And to that point, and it's a really good one too. Now that we're propping up the lawyer, the group of lawyers,
I got to
myself
do a plug at
included.
some point too. A lot of
I
people
appreciate that.
hate
Yeah,
on
very
them.
much. Yeah, my LinkedIn, QR code's right there on the screen. Call me. Um, but to complete that now from triangle to circle to square, I suppose, right?
Yeah.
The lawyer too is a really, and can be a very effective advocate, partner, participant in that process. And when we are giving estimates, for example, on deal work that we're doing, particularly on the borrower side of a transaction, one of the assumptions that we will make to support the estimate is that we're going to get timely and complete information from you client, you borrower client, right?
Oh, yeah.
And so that means
Of,
that not only do we
of
have to
course, they
ask,
always say they're going. You're always going
yeah,
to get that from them.
always going to give you accurate and complete information, but the point is, again, to the founders in the audience and to the management teams, if you don't effectively communicate with me, it's very hard for me to effectively communicate with your lender, with your venture capital firm, with your other partners, in the room or who should be in the room. And alternatively, when you do, and when you founders say to your lawyer, hey, look, before you mark up the document, James, to your point, let's have a conversation. By the way, I want to understand, I'm not sure, founder, I'm not sure that I understand what that rep or warranty or covenant means. Can
Yep.
you walk me through that? That's part of our responsibility as your advisor, as your counselor, as your partner in the transaction, to make sure you understand, to make sure you can stand behind what you're agreeing to do. Can you deliver your financial statements within 30 days of month end, or do you need a longer period of time? Can you deliver your audited financials? By the way, can you deliver audited financials at all? Does your board
Mhm.
require them? Do we need to get you room there? Or can you not get attention because you're so early stage that you really need something more like 180 or 240 days?
Yeah.
Can't always get that period of time. But let's be sure that on the front end, as far as possible, we're building in protection so that you can perform against the agreement that you're making with your lender. Really, really
Yeah.
important. All about communicating, all about setting expectations, all about making sure that our interests are aligned, because they are. Why does that last one matter? Your lender doesn't want to call a default. I think we've talked about this before, James, right? The lender wants a performing loan. They're not
Yeah.
looking for foot faults. We hear that with some frequency too. We need 35 days on monthly reporting. No, you don't. You need 30, and that's fine. We're not going to default you on that. Why? Pick up the phone and call and tell us you're going to be 3 days late on your reporting, or 5. You're not going to get
Yeah.
defaulted for that. Get into a habit of doing that, then we have a different conversation.
Yeah.
This
Yeah.
is
I
like
always
every
try to
this is the
explain.
segment, James, everything I learned in kindergarten, right?
Yeah. What is that? Treat others the way you want to be treated.
Right.
Yeah. It's we had a client and they were talking about they had a TTM revenue covenant. And of course, no one wanted on the company side. And the lender said, okay, hold on. I hear you. Let's do some math on what that means for you. And he goes, if we keep this as we wrote it, you would actually, to be in breach of the covenant, you'd have to drop next year's revenue compared to this revenue 22%. All right, is that really what you're worried about? It's like, oh, actually, I hadn't thought of it. Yeah, never mind.
Right.
I
Right.
always explain that they're structured in a way that they don't have to be anyone's headache because, to your point, private credit, especially within the ecosystem we operate in, it's small. There are a handful of players, but it's a small world, and they'll do everything they can to make sure that things go well as possible before they really put someone into a workout.
And that's exactly right. Here's another, a variation of that same theme, but a really important takeaway, right? The part of the reason that private credit has become this really popular term and a very, very popular asset class is because of the low loan losses. What does
Hmm.
that mean? A very low incidence of default and therefore a very low incident of loan loss. That's why it's such an attractive
Yep.
asset class. That's why there are so many participants getting in. What does that translate into? They don't want to default you. They don't want to default you. They want a
Yeah.
performing loan. And the asset class continues to increase in popularity because of that loan. I can't even say the phrase, that low loan loss, kind of rate and numbers.
And everyone, I mean, sometimes the equity guys don't like it because they get beat out on loans from time to time. But yeah, I mean, companies like it because it's less dilutive. Yes, it comes with monthly payments and some barriers, but it's less dilutive. You can scale credit a lot easier than an equity. You're not. I don't see many companies raising year one of Series B, year two of Series B. It's you raise for a few years. Where credit, I see plenty of deals, and that we structure a lot of deals where it's like, hey, it's 15 million. I need five now, 5 and 9 months, 5, 6 months after that. And the credit guys are happy to do it because it puts capital to work, and they're protected by certain requirements of the company. And the company, yeah, they might be paying mid-teens all in cost of capital, but if you're growing 30% year over year as a result, you're not ripping through cash, you're more responsible with it. And on top of that, your valuation continue to go up. It's pretty simple math to generate the ROI for the company on borrowing that money.
Yeah, and I was having a conversation with a banker this morning in this space, and we were talking about the notion of warrant coverage
Yep.
and how warrant coverage warrants is still something that banks and private credit providers broadly are looking for. Um, but the coverage percentage or the coverage amount is so low
Hmm.
that we were joking that you'd have to hit a grand slam in the bottom of the ninth, appropriate today for the World Series, but for that warrant, even at whatever is the coverage amount to be meaningful.
Yeah.
And the point here, I guess, is a couple fold. It's really no longer the case, I think, broadly speaking, that, well, debt brings with it dilution. No, it doesn't. It brings maybe, and again, it varies on
Yep.
your provider, varies on the check size, et cetera, et cetera. But anywhere from like 5 or 10 basis points, so less than a percentage, up to a couple few points
Yep.
coverage, right? What does that mean? Generally speaking, it's going to be at the north end 3-5% of loan amount divided by share price, right? So it's
Hmm.
not 3% of your company. If it's a percentage of your cap table, it's going to be in single digit, basis points, right?
Yep.
5, 10, 15 basis points. To me, no matter what side of the table I'm on, that's an easy give. It's
Hmm.
almost a throwaway that the provider, the bank, the private credit provider asks for, because if you do hit the grand slam, they want a piece. They facilitated that. And by the way,
Yeah. And aligns
company,
their interest.
and company, exactly right. You should take the view that if you write me that check that gets me to that home run or grand slam, absolutely you should share in the wealth, right? And
Yep.
on the other hand, if we don't have that liquidity event that generates that kind of a return that everybody celebrates over, okay, well, at least it didn't cost you much because you only gave away 15 basis points or
Hmm.
3%, right? So in my mind too, that's another one of these psychological things, James, that we have to sort of not quite removed from the conversation. I don't want to suggest that it's a total non-issue, but it's pretty close. It's pretty
Yeah.
close to a non-issue. That was my Jerry Seinfeld impersonation. So, warrants, warrant coverage. You and I talked, James, and I don't know how we are on time, but
We got
talked.
another couple minutes or so.
Okay. Talked a little bit about, discipline, and the discipline that companies need to bring to the conversation on the debt raising, capital raising in general, but debt raising in specific. And one of the things we talked about was, you know, this notion of the macro conditions and at that things like interest rates. And I think you and I both would have hoped that as of the date of recording of this webinar, which is October 30 for those following along at home, that interest rates would have been even more materially declined over
Yeah.
the course of this year. And they really haven't. And not only have they not, but just the other day, Powell announced like, hey, reductions in the interest rate are not a foregone conclusion, which I think was
Yeah.
a shock to everybody.
Yeah, I saw that. He pretty much said like I wouldn't expect any more this year. Yeah.
Which I think sort of blew everybody's mind. The stock market took a tumble. I was upset. But the point is that in some respects, uncertainty is still the order of the day. In other words, whether it's, and I hate to harp on it, the usual for 2025, tariffs, war, interest rates, right? There's still a degree of uncertainty, a pretty high degree of uncertainty. Now we have, in recent past, there have been some loan losses on the non-venture and on the non-private credit,
Mhm.
sorry, the non-growth debt, couple of car parts, car related, and we're seeing fissures on the real estate side. Are those signals of worse things to come in the macroeconomic environment? Discipline has to remain the order of the day. Earlier this year at the venture debt conference, James, you may recall we were talking about this notion of like survive to 25, or maybe really it
Yep.
was like survive through 25. Why? The idea being, well, the capital markets will be back and more robust, and the
Mhm.
lending and borrowing and capital market in general will be much more company friendly. And we're getting there. We're getting there, but we're not there. We saw an IPO window, and to your first point, James, even since the last time we spoke, part one
Yeah.
of this conversation, where the market was starting to open, we've had a government shutdown. Forgot to mention that one, right?
Oh yeah.
Um, and so uncertainty needs to be we need to be mindful of it. I don't want to suggest that like we should live in fear. We shouldn't live in fear, but we should live mindful of the fact that we're in an uncertain macroeconomic environment. We see, generally speaking, the market up overall, so that's good. IPO market very soft again, strange.
Yeah.
Nobody would have expected that. What does that all translate into? Founders, companies, management, you still have to be conservative with cash flow. We still have to be careful about preserving capital. We still have to be careful about, are we actually taking on debt to extend runway to the next financing? Are we communicating effectively with our venture capital partners sitting around the table so that they know, hey, there is going to be a time when I am going to need you to come back and help support me, et cetera, et cetera.
Yeah. No, I think it makes sense. So as we wrap up here, any final words for those watching or those who will be watching?
Right. Let's see. I took some notes. Let's see. You know, uh, Here's one I wrote down that I like. Debt is not a parachute. It's an accelerator
Oh,
when
I
you
like
already
that.
know the direction, right? I would claim credit for it, but it's not mine.
Oh, I was going to ask you if I could borrow that sometime.
You could borrow it because I don't own it. It's fine. Debt is not a parachute. It's an accelerator when you already know the direction. It's going to sound Pollyanna or simplistic, but we've talked about it here, and James, you and I have talked about it because I think it actually really, really matters. The takeaway principally is communicate, 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 and then I guess the other one is conserve cash. That's another double C.
Yeah.
So, you
Don't spend
know,
like it's going to keep coming in.
yeah, uncertainty is real, but it doesn't need to rule. That
Yeah.
was good. I
Oh,
just
I
came
like
up with
that
that one
one.
on the fly.
Is that a
Yeah,
Troy original?
those are my exactly. So those are my final comments. What about you, James?
So yeah, I mean, I honestly I like that accelerant comment. We are always advising companies, focus on get a path to profitability. Don't. One of the big things that we advise clients on is be realistic in your expectations. We'll see clients, you know, we from a preview until we get the updated, a kickoff process might be a few weeks, and they've updated their financials with actuals, and they completely misplan, and then we see their plan for the rest of the year and it hasn't changed. Like you're not going to hit this, so you can't
Right.
spend as if you are. So to your
Right.
point on conserve cash, you need to spend realistically, not spend into your hope, spend into what is most realistic, and then if you outperform, great. You can spend a little bit more.
Yeah, great points. Great points.
But yeah, I mean, I will say what we're seeing in the markets is there's a lot of activity still. Borrowers looking to borrow, lenders looking to lend. It's where we see a lot of activities in that 5 to 20, $25 million range. They don't get the flashy headlines like the $200-300 million private credit loans, but if companies are looking for that 5 to 20 million range, there are a lot of lenders out there very interested in putting capital to work, and it's been very busy for them the past really 2 years.
Yeah, great point, and I'll just echo it if I might, so that at a minimum we end on a high note. You're
Yeah,
entirely right, and I'm not just saying that so that we end on a high note. You're entirely right. The landscape of providers has gotten more and more extensive, even in the last couple of years. The amount of capital out there to be deployed and getting deployed is real, is significant, and I think that the group of providers to sort of this segment of companies, that whether you call them venture debt or growth, um, are more and more comfortable that, in fact, even if the public market isn't entirely open today, that we're headed in that direction. And notwithstanding those uncertainties, we always have uncertainty, that we're in an environment where you're exactly right, James. They're prepared to and are writing checks, are having regular conversations with the VCs sitting around the table. The VCs are writing checks again. They are having very important, very valuable conversations, not only with their portfolio companies, but with the banks and the other private credit providers, to ensure that this sort of virtuous cycle continues to chug along. So
yeah,
survive to 26, I guess.
yeah. We'll just keep saying that every year until we get our wish.
Yeah. Well, look,
Well,
James, I really appreciate, as always, you making the time, and we'll look forward to part 3 of our webinar. Maybe we'll do it live. Maybe we'll do the
yeah,
meta.
I think we'll work on some technical issues before then.
Yeah, very good. Thank
Excellent.
you.
Have
Great
a
to
good
see
one.
you.
See ya.
Bye.